some of the big financial advisors, whether it's Robert Kiyosaki or a number of others that talk about how real estate can potentially make it tax-free for you because of the depreciation. So how does that actually work in a practical sense? Because when I read that book, Rich Dad Poor Dad, like 20 years old, I mean, it's very high level. It's not meant to be like tax advice, but it gives you, it gets the wheels turning, and that's why you turn to professionals to really like play that out. But how does depreciation in a practical sense that someone, say they invest in a multifamily property, they're like a syndication deal, they put in $100,000, they're going to be getting depreciation back on their K1. Anyway, so outline how that practically works for the professional out there that's passively investing.
So when you invest in a passive state, it stays in a passive state. It's going to go and flow to, so if you invest $100,000, and let's say that syndication, meaning a group of investors who put money into an apartment complex or a commercial building or a retail building, whatever you're doing, they basically are pulling their money together. So ultimately, you're going to get a fraction of that deduction. So most of those plays are what they call accelerated depreciation. That's when they do this cost segregation. That's just the name of special depreciation, that you can take a front load of depreciation up front the first 2-3 years, massive. You can take it over the 27.5 years, but the first 2 or 3 years, cost segregation gives you a big POW. That's what I call it, a big deduction. And now thus reducing your taxes. So the key is turning that passive into either a participant or active stage, because once you do that, that flow through will go and eat up against your, like I said earlier, goes and attacks your active income, thus reducing your taxes. Now, if you're passive and you're multiplying your money, which is not a bad thing, multiplication of money and building wealth, that passive will pass over to your passive section. And if you're over a threshold of salary income, there is a point of the deduction that you can take up to $25,000. If you're married, filing joint, I believe it's $250, $275. If you're single, it's about $125,000 that you can take up to that deduction, up to $25,000 in deduction. However, when you're active, there's no limit. When you're a real estate professional, no limit. And as a real estate professional, I'll go into that. It does require some time involved, but
and for me, like that was game changing for us. Like before you get into that, like our case study, because we both had full-time jobs. This is 10 years ago. Did a few rentals. It started off very passive, but then we started doing some flips.
Yeah.
Then we bought a 29-unit apartment complex.
Boom.
Now that was very active, because that thing was a mess. Like we bought this apartment complex for like $15,000 a door. Like wow, you can't even buy doors for that now. Man, I wish I still owned it. But anyway, that year working with my CPA, we determined that I could qualify for a real estate professional, and our tax rate went, or like a net effective tax rate, it went down to like 5% or 4%, which from a normal perspective, I think at the time we should have been at like 22 or something, at least on the higher brackets. It went down to like 5. Like
incredible.
So
right?